he had a follow-up question. Is it better to do multiple spread contracts or do a wider leg spread? My preference is to multiple contracts, but that's just a personal preference. You know, I typically I have a portion of my portfolio allocated. Let me clarify this real quick. Let's go back here to the bull put credit spread screen. There we go. Okay. In the credit spread positions, and you saw an example of this. I forget which one we were just looking at. Oh, it was the one that when I accidentally slipped to a 10-point spread and I thought I was doing a 5-point spread, and we were looking at the spread chain when I shifted. Remember, we were looking initially at the bull put credit spread with a 2.5 points for NVIDIA. Here it is, with a 12.4% return. But I accidentally did it at the 5-point spread instead of the 2.5, and we saw the 57.5. I'm so sorry, 547.50 and the 542.50 bull put credit spread, and the 10-point spread had a return, I think, of only 11%, if I'm not mistaken. We went up to the higher 15 spread and we were looking at the 552. But using the same strike here, just let's run a quick screen here. This is an 86.4% probability. Let me clear the filters. And I'm going to look 8 to 17 days out in time. And I'm going to look for a probability of 85 to 87. No strike difference restriction, more than one result per security. I'm going to sort the results by highest return. And we are just going to look at NVDA. All right. What did I just do, David? I just isolated all combinations with a 500, or a lot of the different combinations with a 547.50 strike, which had the 86% probability. Here's the 2.5-point spread offering a 12.4% return at midpoint. Here's our 5-point spread, 11.1. 10-point spread. Is that 10? Yeah, 547.50 to 537.50, 10.3% return. 7.5-point spread, same 10.3% return. 12.5-point spread at midpoint, best possible scenario, 9.6% return. This is commonly what you see. Looking at stocks 90% of the time, comparing the different strike spread width of the positions. The wider the spread, the lower the return against the risk. You're getting a higher net credit, but I'm moving up to a 450 risk, a 907 risk. So here's an example. 2.5-point spread. We're getting a 28-cent net credit at midpoint. Again, best case scenario, I know. But that puts our risk at 227, 223, 222 for the 2.5-point spread. The 5-point spread almost doubles the risk, but I don't quite double the net credit. It should be at 56 cents or 54. It's only at 50. From there, we double it up a little bit more than double. We move from a risk of 450 to 907. Don't quite get double the net credit. We're not at $1. We're at 94. And so on and so forth. That's typically what you see. But again, there is nothing wrong if this is still in my wheelhouse. This 11% return still would meet my criteria possibly for an 11 or 14-day trade. 86.4% probability. I like it. There's nothing wrong with it. But typically what I do, David, in my portfolios, I've allocated about 10 to 15% of my total portfolio value to trade credit or debit spreads. Why? Because at one point, this portion of the portfolio will be down 40 or 50%. It's the nature of spread trading. Even with an 85, 90% probability, even going 7, 8% out of the money, 14 days, or going 10% out of the money, 30 days, the unexpected black swan event will happen. The stocks are going to get near the short put strike price or drop below it. And my goal is I need to close these positions for 50% of the maximum risk. I can't take 100%, 70%, or 80% of the maximum risk. You'll see that in another video in the playlist there when we talk about management. The lie of leverage works both ways. And if you allow these risks to go up to 70% of the maximum, even if I'm making 12, 13, 14, 15%, and I'm right 80% of the time, 85% of the time, I can't allow the losses to go to 70%. They have to be right around 50% of the maximum. But long story short, what I'm going to do is take, 25 to 33% of this 10 to 15% of my portfolio. So if I had a $100,000 account, I'm allocating, let's say, $12,000 to credit spreads, 12%. And I'm going to say that I only want to do 3 or 4 bull put credit spreads at a time just to keep it easy. And I'm going to go from that main search list, which are usually 2.5 to 5 point spreads mostly. So I'm going to have more multiple contracts with a tighter spread, usually the lower strike difference, which gives me the higher return. It's just common of what you see when you look at these positions, because the credit is not doubling as the risk is doubling. So I think it's better for the bang for the buck, especially in the shorter term weekly or 2 week out credit spreads, to focus more on the percentage return as opposed to the monetary net credit. Because either way, if I was doing the 2.5 or the 5 point spread, I've got $12,000 in a $100,000 account, or 12% of my portfolio allocated to spreads. And I'm going to break it up into 4 of these, not these ones, but on the search, David, 4 of the potential trades. NVIDIA might have been one of them. Well, I'm going to be allocating, of course, $3,000 to each. Or I might do 33% and allocate $4,000 to 3 trades. But in which case, it doesn't matter if it's a 2.5 or a 5 point spread. I mean, it does, but I'm allocating $3,000 to it. So on the 5 point spread, we'd be looking at 6 contracts. On the 2.5 point spread here with 3,000 would be closer to 10 contracts. But the real thing that you can see, and this would appear from, let's take an example. While we're here still, it's 550, no problem. We did NVIDIA, of course. What about Apple? Now, I don't know if Apple has something that's in the 85 to 86% probability. Okay, so we got to open this up. Let's go 84 to 88. Just based on where the stock is and where that one strike price is, I'm trying to isolate to with the high probability. Fantastic. Same thing. 2.5 point spread, 182.50 to 180. Same expiration, 16% return. We go to the 5 point spread. 13% return. Should be 70 cents if I'm doubling the risk, but it's not. 10.5% return on Apple for the 7.5. 10 point spread, 8.8% return. 12.5 point spread, 7.4% return. Same short strike, same probability. We're just basing it off the different tandems on the short strike that have the 86, 87% probability we want. But like I said, multiple stocks we could take a look at. Let's just do MCD. So Apple, tech, NVIDIA, big tech, popular, volatile recently in the news. What about McDonald's? Much lower returns. 2.5 point spread, 6.2. 5 point spread, 5.5. 7.5 point spread, 4.7. 10 point spread, 3.5. Okay, so that's typically what we tend to see across different stocks. Someone says, why not SPY? Ooh, that's going to produce too many results, but okay. Because we're going to have dollar strike differences and things of that nature, but let's see. Let's go to SPY, why not? And you know what you're going to see. 1 point spread, 12.4% return. 2 point spread, 11.4. 472 to 470. Oh, so that's the problem. Okay, so now I got 12s and 14s. Let's stick with the 471s 14 days out. That's the daily options we're going to get me to. 14 days out, my apologies. 471 strike. 1 point spread, 12.4. 470 to 469, 14 days out, February 2nd, 11.4. 471.14 to 468, 3 point spread, 10.3. You're losing 1% for every dollar strike difference you include. And this is the 3.5 points. Yep, 3.5 points, 9.9. 4 points, 9.6. We're 30% lower than the smaller spread 1 point at midpoint, of course. Best possible scenario midpoint. You get it. So, but again, you could see it. Multiple stocks: McDonald's, SPY ETF, Apple, NVIDIA. We could look at many others, but you're seeing the same pattern. This is why I tend to prefer the 2.5 to 5 point spreads with my allocation set up to what I'm doing. No, I'm not using $12,000 in a $100,000 account, but yes, 10 to 15% at any given time, around 12.5% commonly is what I have allocated, because at one point or another, a black swan event will occur. The falling tide will take down all boats, even though everything looked bullish. And we said the strong market sentiment, the market buys is our last signal. Came off a bottom. Fantastic. Powell comes out and says something that we weren't expecting. The new jobs report is not what we were thinking it was. The market takes a hit. You can't allow, as I mentioned, those spreads to take more than a 50% loss. So it's possible that all three spreads that I've opened at that instant will be down 40, 45, or 50% of the maximum risk. I close all three. I took a 50% loss on that portion of my portfolio, which was only 12% or 15% allocated, which means the maximum hit my whole portfolio took was only 7.5 or 6%. I can stomach that, keep that in single digits, and make that back in the right market conditions with the leverage strategies. But if I allow it to go to 70, 75% loss, I'm now way too low in the money that I'm putting in without allocating more of my portfolio to it to get back to break even. Yeah, 50% loss means I need 100% gain on what I have left to get back to break even. That's how the lie of leverage works. But I've been able to do that consistently, even with surprises, with our credit spread approaches, what we look for in our credit spreads and so forth as well. Wow. So that was a great question. It was a very good question, David. It's an awesome question to ask as a follow-up, and I think we covered it pretty well, probably better than what you might see in one of those older videos where I addressed it, because that was a pretty clear-cut example of the difference of wider spreads and shorter spreads on different types of stocks, different types of securities. It's common. Wider spreads, less bang for the buck, return-wise against the risk. Sometimes it's better to stay with the shorter spreads if available for that higher kick. The lie of leverage. Use the leverage for your favor. That's why we're doing the spread positions. But the lie of leverage works both ways. Make sure you're only using it as a portion of your portfolio.